What if I told you there's a way to invest in India's top 50 companies with even 500 rupees? A way where you don't need to research individual stocks, track quarterly results, or worry about picking the wrong company. Well, that way is called index funds. So what exactly are index funds? How can they help you generate good returns? Well, I will simplify it for you in this episode of Finance Now, where we make finance easy for you. Think of index funds as buying a complete thali instead of ordering individual dishes. When you invest in a Nifty 50 index funds, you are automatically getting a portion of all 50 top companies in India in just one single investment. Basically, an index fund is a type of mutual fund that simply copies a market index. For example, if the Nifty 50 goes up by 10%, your index fund goes up by roughly 10%. If it falls by 5%, your fund also falls by about 5%. There's no fund manager trying to beat the market. The fund just mirrors whatever the index does. So is it somewhere like regular mutual funds? No. Regular mutual funds have fund managers who actively pick stocks and try to beat the market. On the other hand, index funds simply track the market without any active management. So how can you use it for your advantage? Well, you can build wealth systematically and keep more money in your pocket by simply choosing low-cost index funds over expensive actively managed funds. Let's take a real-life example to help you understand better. Suppose you invest 1 lakh rupees for 10 years in an active mutual fund. You get 12% annual return on your invested amount, but this mutual fund has an expense ratio of 1.5% per year. After 10 years, your final amount will be approximately 2,71,000 rupees. In another scenario, suppose you invest 1 lakh rupees for 10 years in an index fund. You get 12% annual return on your invested amount, but this mutual fund has an expense ratio of 0.2% per year. After 10 years, your final amount will be approximately 3,05,000 rupees. So even though both investments started with 1 lakh rupees and aimed for 12% market returns, the lower expense ratio of the index fund helps it earn approximately 34,000 rupees more over 10 years just by saving on fees. That's the power of keeping costs low and letting compound interest work its magic. In India, you can invest in different types of index funds such as broad market index funds, market capitalization index funds, equal weight index funds, smart beta index funds, to name a few. Index funds are a crucial investment option for beginners in the Indian stock market. So do you also invest in index funds? Do share your thoughts with us in the comment section below.